Welcome. My name is Van Richards. I'm a chartered financial consultant, and I'm here to talk to you today about how to identify different stocks that will fit well into your saving strategy, whether you're going to be saving for retirement or whether you're going to be saving for something else like a child's education. My goal is to help you to identify different stocks that may fit well for you in your particular strategy. And the way that we do that is we pick apart the different stocks and we look at a couple of different things. Three things are, these are the cornerstones of good stocks. The first thing that we'll look at is we're going to look at earnings. The second thing we're going to look at is going to be competitiveness. And then the last thing we talk about is stability. Now, if a stock can meet all three of these criteria, then you have identified an excellent stock. You just have to be able to understand the volatility and the risk that's involved and see if it's going to fit you in your particular saving strategy in building money up. We don't talk about swing trading or day trading. We're here to help you accumulate long-term money. And one of the big things that I do for clients is I tell them I can help you to set up a retirement plan so that you will never run out of money. Now, it's just not with money. We look at a lot of different aspects of a person's life. But that'll be something for another day. So without delaying too much more, let's go ahead and get into the NASDAQ stock analysis. Okay, the company that we had to talk to you today about is VeriSign. Now imagine that you're on Shark Tank and you're sitting there with Mark Cuban and all the other members of the Shark Tank, and you're one of the sharks and you have money to invest. And the person that is coming in to talk to you about this particular investment tells you this: I have a product that anybody that uses the internet has to pay for. Everybody that uses the internet has to pay for this. They have to pay me. How would you feel about that particular investment? Now, the company that we're talking to you today about is not quite as good as that, but it's close. It's really close. This is VeriSign. If you have ever used a .com, which you're using probably today, or .net, then you've used VeriSign's services. Let me give you just a little flavor of what VeriSign is and what they do. It's a very simple concept. And, that's one of the beauties of successful companies. A lot of times they're not very complicated in their success. So let's talk about that just a little bit. And let me make the screen just a little bit bigger for you. And I'd like to show you just a little bit more about VeriSign so that you understand where they are and where they're going and where they've come from. VeriSign has a capitalization of $24.3 billion. It is by far the largest domain registry company that exists. I'll say public company from that standpoint, because it's really interesting when we start looking at different stocks that actually they are a registry that's directly registering domains. There's not a lot of them. A lot of them are actually private companies. And it took me a little bit to do this research. You're going to see when we look at the competitiveness of this company that there are a couple of companies out there, but really there's not another company that's like VeriSign. There's companies that are similar to it, and we'll talk about those just a little bit as we go through today. So if we go back and we look at VeriSign over the past year, a year ago on October the 14th, they were trading at about $185.75 per share. They ended today, and this is actually incorrect. Let me do this real quick if I could, because that number is not correct. I want to make sure that I get the right one for you. Because VeriSign did not go from 185.75 to 518. Just when you think you've got everything taken care of, there it goes. It doesn't work. All right. So when we look at VeriSign, hold on, bear with me, folks. I'm going to get you the real price on this for just a second here, because this is really well worth waiting on. VeriSign ended today at 212.15. That's what we want to look at from the standpoint. So X out that 518, that was from yesterday. It ended today at 212. So I'm going to go past these because this is not correct. All righty. Okay, let's get right into talking about the earnings for VeriSign, because it's really, when we look at VeriSign, VeriSign's been around for about 21 years. If you've used the .com or .net domain registry, then you've actually seen and you've used VeriSign services. We're going to go back to 2014 and look at the earnings going forward from that standpoint. And they've met expectations every single year. Now, in the last quarter, it's amazing what happened actually, it was the first quarter of this year. We saw actually 11.1 million new domains were signed up for. That brings the .com to 148.7 million and the .net to 13.4 million. They had an operating margin of about 65%. A margin, remember, a margin is profit. That's pretty interesting for a company like that. You know, a lot of times if you have a 10% margin, that's a good thing, but a 65% margin. The first quarter, remember in that last graph that you saw where you saw that great big huge spike, that represented 127% increase in first quarter earnings per share. It went from $1.26 up to $2.86 per share. That was huge. Now, what we've seen is, and I mentioned this before with VeriSign, they've been around for about 21 years. And what makes them so stable? Remember, you're the gentleman or the lady that's sitting on the couch with the sharks, and this person's pitching this company to you, and they're telling you, look, I have contracts with every major company that has a .com registry. And for 6 years, they have to pay me every single year to renew their .com registry. And I can increase my rate that I charge to them by 7% every single year without a doubt. Now, as we go forward and we look at the .net registry, it's interesting to see that the .net registry is very similar, except the .net registry can increase their rate by 10%. So you've got a company that it's a fair weather and foul weather company. If we talk about the moat on this company, remember what a moat is. A moat is this. Take a look. Remember that a moat is that imaginary barrier that's between the company that you're analyzing and in between their competitors. Now, I've already told you that there is no company like VeriSign, but that doesn't mean that they're immune to competition. If we take a look at actually how they do well over top of their competition, they actually have a monopoly over the .com and .net. Now, there's a worldwide nonprofit organization that oversees the registry of domains. It's called ICANN. And ICANN has a really pretty good relationship working with VeriSign. Now, the interesting thing about VeriSign is they have a contract with ICANN to offer the domain registries, the .com and the .net. And it comes up every 6 years, as I mentioned before, but it is not open to other bids from outside companies unless VeriSign violates part of the contract. So this is just, it's been going on for 21 years and it's got the opportunity to continue on for many, many years. So if we're talking about a company that has the potential to be profitable over the long term, then VeriSign is going to fit into that criteria. As far as, you know, when we talk about those three things that we talk about, the earnings, competitiveness, and stability, this adds to the stability a great deal. And when we're talking about a moat, that's a big, significant thing. It also has the network effect, because if you're starting a company, unless you're a technology company, some other companies may want to get a .net, but even still, .net is number 5 as far as popularity goes for domain registries. .com is number 1. So if you're going to start a company, you probably want to get a .com registry. That's just the way that it's going to work. Now, They have ongoing subscriptions, which makes the moat better. Now, as I start to talk about this, I don't mean to sound overly positive about it, but there are a lot of positive aspects to it. We'll talk about the negatives here in just a minute. But they have a good relationship with ICANN. And just in case you ever wondered what that really stands for, is Internet Corporation for Assigned Names and Numbers. The domain registry for .com is about 148.7 registered users, and they're going to be there through thick and thin from that standpoint. If you have a company, you're probably going to continue your .com domain. Now, here's a couple of negative aspects. You have to keep this in mind too, because remember, when we talk about a stock, that's the ownership of the company. And, you know, with the ownership of the company, you have to take the good with the bad. Now, we've talked about the different good things that are going on with VeriSign, and that's significant. But we have to identify also what could possibly go wrong with VeriSign. And the first thing is that if you own a company and you have all of your assets or all of your investments for your company in one particular area, you're not very well diversified. Yes, as I mentioned earlier, they have 2 of the 13 servers that serve worldwide internet usage. Now that's significant, but most of their business, about 90% of their business, is going to be tied up within the .com or .net registries in itself. So that's a negative, because just in case if something happened and they could not renew that .com and .registry, that .com and .net registry business, they would have some serious problems. But that doesn't seem to be the case right now, and they've gone pretty successfully for the past 21 years. Other domain registries, as they become more popular, can dilute that. And there's all kinds of them. You've seen them, everything that you can imagine. Go over to GoDaddy, which we're going to talk about in a little bit. You can see all kinds of different registries. The increased use of social media also dilutes the usage of different registries. Now, what do I mean by that? If you use Facebook or you use Twitter, you're using that company's app. You're not going through the .com or .net registry. You don't have to go to your internet and type that in to get to it. You can, but you don't have to if you use the app. The more people that use Twitter, that use Facebook, that use YouTube directly through an app, then that dilutes the benefits that goes along with the .com. Now, will it make it go away? Personally, I don't think so, but it's always a possibility that's out there. Let's look at some of the competitors that just kind of stack up with it. Now, I've told you before that there's not a big competition out there. In other words, there is no other company that's like VeriSign. That's why there's not a lot of coverage of it, because when you look in a few minutes, you're only going to see that there's 2 analysts that are covering VeriSign. It's a really boring company, but it's profitable. What's wrong with boring and profitable? When we look at a company and we compare it to a company like Endurance International Group, and you may be familiar, they own a couple of different things like SiteBuilder.com, and they own Constant Contact, and a couple of other different companies that are like that. They kind of are in competition with VeriSign, but not completely. If you look at the spaghetti graph, you can see, let me make this just a little bit bigger for both of us so that we can see it. When you look at the spaghetti graph, you can see that actually in the past year, Endurance International Group had a big spike. We're not here to talk about that, or we'd be talking about what happened here right after the coronavirus market crash. But if we look at VeriSign in blue, it has had a pretty good run in the past year. They came out of the coronavirus pandemic crash pretty well, and they've continued pretty steadily since that point in time. Now, GoDaddy is actually had a better year than they have. Let's take a look and see what the actual rates of return for the past year have been for these different companies. VeriSign itself has had a 14% increase this year. Verizon has had a 2% increase. GoDaddy's actually had a 23% increase, and Endurance International Group has had a 58% increase. And then there's AT&T that's down about 21%. But What's the difference I want to point out between GoDaddy and VeriSign? And the reason why I want to point that out is because GoDaddy actually uses VeriSign's registry business a lot. So if you go through GoDaddy to get a .com registry, and I actually use GoDaddy myself, so I'm kind of familiar with this. So if I have richardsfinancialplanning.com, which I registered through GoDaddy, but the .com is actually registered with VeriSign. So there's a connection in there from that standpoint. Of course, GoDaddy makes some money off of it, but GoDaddy does a lot more different things than VeriSign does. VeriSign doesn't make websites and do that type of different thing like GoDaddy does. Okay, so let's go back a little bit further because I think it's very useful to kind of look and see how this company has performed maybe over the past 5 years. And over the past 5 years, when we look at GoDaddy, just to give you some relevance, GoDaddy has had a 178% increase in its stock value over the past 5 years. We've also seen the APR. Actually, I've kind of messed up on numbers today. That 14% is wrong. When we look at VeriSign, VeriSign has had about the same rate of return too. That should actually be 178 and 23. Got to be more careful on my numbers from that standpoint. Now, I talked about this earlier in the week. If you've listened to me when I'm talking about different stocks, and one thing I want to point out is, as the profits are made, let's say that this company can increase their revenues every single year. Those revenues still are going to be taxable, those that they retain. A big thing, as you might have seen earlier, is that this company does not pay dividends. Profits are retained at the company level. So as VeriSign retains profits, it's a large enough company, it's a corporation. If taxes go from 21% to 28%, you're going to see profitability of this company go down. So just keep that in mind as you're looking at these different stocks going forward. Now, today they finished at 212.14. What Morningstar is saying is that this company has a fair market value of $154. So in reality, they're going to say, Morningstar says that this company is trading at a 37.75% premium. They only give it 2 stars. But remember, the star system is not like you're getting Michelin stars for a restaurant. Stars are going to be for the value of the company. So it's not fair value now, it's slightly over top of it. It's not like Apple or like Tesla, though it's far over top of its fair market value, but its fair market value is pretty high from that standpoint. Now, I mentioned this earlier when we look at the different analysts that are following VeriSign. It's a boring company. But I'm telling you, it makes money night and day. It's like having a money machine. Now, it doesn't make huge profits. Like, it's not going to have a profitability like a Tesla over the past year of over 600%, but they've had a steady profit for the past 21 years. So it's actually really done pretty well. When we look at what other analysts are saying, and the 2 analysts that are following this, they're kind of split. One of them says that it's a strong buy. One of them says that it's a hold. So it's going to actually come out to be this. So it's not going to be a strong buy. It's going to be a moderate buy. And actually, I would probably be more in the camp of leaning towards a strong buy. And the biggest reason is when I look at the 3 things, let's talk about that real briefly. When I talk to you about the 3 things that you look for in a stock, you want to look at the earnings. The earnings on this company are solid. They continue day in and day and night. We also look at the competitiveness. When we look at the competitiveness of this company, we compare it to everybody else. There is no other public company that's like VeriSign. All the other companies, the AT&Ts, the Verizons, they don't do the same thing. They don't have the same contracts. We have contracts when we talk about stability. The stability is built by the fact that VeriSign has 6-year contracts on the domains that they register, the .com and the .net. So you've got earnings, you've got stability, and you've got competitiveness. That's the hallmarks of a good company. Now, it might not fit perfectly in with you because, if you think if it's such a good company, how come it lost money this year during the coronavirus market pandemic? Well, every company did. There was no company that was immune to it. What you want to do, and this is a good stock tip for you, what you should do is, if you like VeriSign, build it into your accumulation strategy so that you can continue to grow with it, because you could probably think that it's going to continue. Of course, we know, and I have to state this, the past performance is no guarantee the future performance. But the other thing to consider is that keep an eye out on this company, because things like the coronavirus market crash that occurred in between February and March, hopefully that never happens again. But I will guarantee you that if you live long enough, which hopefully is going to be a long time, you're going to see another market decline. I don't know when. Be ready for it. You can accumulate money by buying this stock on a regular basis if you want to, if it fits your criteria. But set aside money, and when it goes down, buy. That's the whole idea of a stock market strategy. The other thing that works real well as a stock market strategy is having a portfolio, because you've heard the old adage that if you put all of your eggs in one basket, then if one particular investment that you've concentrated on goes down, then you've lost most of it or everything. If you go to, let's say, for example, the NASDAQ 100, that's the 100 stocks that I generally report to you every day on. And when I report to you on those particular stocks, the idea is to give you some understanding of how they work so that you can see if they're going to fit into your strategy. If you buy a portion of all of those stocks, you're going to have days where you're going to have an average that's going to go up. It's going to have a slight tilt upwards. But you're going to have days today, everything in the market on average was down. But if you look at some of the individual stocks, like, let's say, Baidu.com, we've talked about before, Baidu was up big today. If you look at Tesla, Tesla was up today. But on the other side of the story, if you look at companies like Illumina or like Splunk, and we've covered them recently, they were down significantly today. But if you have an average, then that average is going to work to your benefit. Now, should you buy every stock? No. I'm a bigger fan of the NASDAQ 100 than I am of the S&P 500. With the S&P 500, you've got some stocks in there that are really not that great. And I don't cover the S&P 500 as much because there's too many different stocks in there that are not that great. I want to look at it this particular way. Let's say, for example, that you ran a company that had 500 employees, and you knew that you had a handful, let's say 8 or 10 of them, that were late every single day. They took long lunches, they missed days. Would you keep those employees around even though that you knew that they were a drag on your company's profitability? Let me answer for you. Probably the answer is going to be no, you wouldn't. So if you have 500 stocks and you have a handful of them that are not doing really well, why would you buy every last one of them? I don't know the answer to that. I do know that the average NASDAQ 100 stock is more profitable than some of those lower stocks that are on the S&P 500. That's why I prefer following the NASDAQ 100. It's actually been a superior index over the past years. And I use a concept called direct indexing. If you want to learn more about that, go to my website, go to the blog, look up direct indexing. You can learn a lot more about it from that point. Okay, so we've gotten to the stage that I'm going to say I've covered everything that I wanted to cover today. And I'll tell you too that if you want to get my advice on what you should do with your investments, if you'd like to talk to me about your saving strategy or about your retirement strategy, go over to my website at richardsfinancialplanning.com. Go down to that teal colored button you see that says schedule a call to learn more. If you click on that, then you and I can set up a time through my calendar to have a conversation. Now, I have to tell you that I only do this for residents of Texas because that's where I do business. If you're someplace else throughout the world, I'm glad to answer your questions and to converse with you. If you have questions too, make sure that you enter them in and subscribe, because I get lots of new information that I put out every single day, and I bring it to you to help educate you on how that you should use stocks so that one of these days you can retire and not run out of money while you're doing it. So with that, I'm going to say thanks for joining me, and I hope to hear from you, and I hope that you come back tomorrow. Have a good evening.